Did you know that mortgage-backed securities, MBS, were invented by Dutch banks more than 200 years ago? And when those early MBS market collapsed, they triggered a financial crisis strikingly similar to the 2008 global financial crisis. Dear listeners, welcome back to Insights Out with Dr. Jen. Today, I'm kicking off a special two-part PhD series featuring my colleague Dr. Tim Koyemans, who recently achieved an incredible milestone, publishing in the Journal of Finance, the top ranked journal, which is actually number one in the finance field. In today's episode 19, we will dive into the research itself, which uncovers the fascinating story of bank reputation and early MBS markets in 18th century Netherlands. Then, in episode 20, we will go behind the scenes with Dr. Tim to hear the untold stories of his publication journey, from an Amsterdam PhD to the Journal of Finance. Now, let's get started. Tim, welcome to the show. How does it feel to have your work recognized at this level?
Thank you so much, Jennifer, to have me on your show. It's great to be here. And it's also great that we've been able to get this paper into our favorite journal, the one that we rank the highest in the finance rankings. That's what we find very important. I say we because this paper is a joint work with my dear co-authors, Peter Koudhuis and Abadiel. The paper actually hasn't been published yet, so it's forthcoming. It will be published somewhere this year, but already basically everyone around me in this university and in other universities, everybody that I speak to already knows, which is very nice and very exciting.
How do you feel when you first heard about that you were accepted by this journal?
Very excited. Yeah, super happy, of course. It was also, we've been working towards that point for such a long period of time, because the first time instance submitted our paper to this journal was 2 years before that, right? So it was a huge relief that it actually got through in the end, because I was hoping for that for such a long period of time.
Yeah, there's so many things I want to ask you. First of all, Tim, for a lot of non-finance people, looking at MBS, mortgage-backed securities, they are at loss. So if you have one sentence to explain to the people who never understand finance, what is your research about?
Right. In that case, I just leave out the whole mortgage-backed securities MBS story. So I explain that what we try to do is to understand the financial crisis a bit better and understand how and why they happen.
When I read your paper, I was surprised. I found out that MBS exists in 1760 or something, because I have taught the risk management and derivative class in the university for past 5 years. I thought it was an invention, financial innovation during the global financial crisis. So, can you tell us what inspired you to study this topic in such an old time?
Yeah, it was, to me too, very surprising that they already had these mortgage-backed securities so much a longer time before the GFC. And the main reason to study this particular episode that they also use these mortgage-backed securities is really because it's the only boom and bust, so the only credit crisis prior to the GFC that we know of that was caused by the same mortgage-backed security issue. Basically the same reason, the same factor that caused the GFC was also causing a financial crisis, but then 200 years earlier. This is the only one that we know of that is also, there was a key role for these mortgage-backed security in causing the financial crisis.
Wow. I read so many things about the global financial crisis. Nobody ever mentioned such a similar crisis happened 200 years ago. How did you find that? Do you think it's because you actually from Netherlands, that's why you know this piece of the episode in the history?
That's right. It has been described by Dutch historians. So they were aware of this crisis and they've described what went wrong. But it was totally, of course, unknown, as you say, to the whole finance literature, to all the finance researchers. And nobody really has studied this very old financial crisis in detail because it's such a huge task to collect all the data that you need to actually properly research this financial crisis.
If someone picks up your research 50 years from now, like in the future, what's the one insight you hope them to remember?
The biggest insight probably is that we understand a little bit better one particular factor why in some settings banks could do things that seem irrational or that seem against their own interest in hurting their reputation quite a bit. And we show that perhaps an important factor in that is personal exposure of the bank managers, as we talked about. I hope that they still need our paper to understand this reputation effect and the interaction with the individual exposure. And I hope that there hasn't been a new financial crisis caused by the exact same problem in the meantime.
Do you think history will repeat itself?
There's this nice quote which goes like, attributed to Mark Twain, and the quote is, "History doesn't repeat itself, but it often rhymes." It's never exactly the same, but there are these kind of themes that reoccur. And we do learn from history, I think, and that's definitely one of the goals of our research, to learn from history. But then we also tend to forget again. It takes too long, right? So once the generation that has actually experienced the event is gone, and it's hard for the next generation to remember those things, even though they're written down, right? So we learn, but we forget.
Yeah, so when they read your paper again, 50 years later, God knows what's happening, they may say, somebody already told us, right?
Exactly, and that's exactly what we did in the last financial crisis as well. It's there, but we forgot.
It's not our generation. It seems like it never happened. Let's have some fun question. You have worked hard enough. If you have to describe somebody want to make your research into a movie, what would it be? Give a movie a title. Remember that Big Shorts movie?
Big Short, yeah.
Yeah, the global financial crisis. If your movie, Dutch Bank, what will it be?
Well, the titles we give to our papers are kind of movie titles. The first phrase is often a catchphrase, right? So going for broke is the name of this paper. So going for broke means risking it all. There is actually a movie that is called Going for Broke. It's a movie about gambling.
Okay, Going for Broke #2. Now, in the next 15 minutes, I have invited my two AI assistants, Amy and Jonny, to explain this paper clearly, yet in a fun and easy to follow way, even if you are not a finance expert. Let's listen into Tim's paper, Going for Broke, Bank Reputation and Mortgage-Backed Securities in 18th Century Netherlands.
Welcome to the Deep Dive. Today, we're going to be looking at some fascinating financial history. 18th century Dutch plantation mortgage-backed securities.
Wow.
You'll be surprised to learn that a lot of the financial mechanisms we take for granted today have actually been around for quite a while. Our sources take us back to the 1760s, where Dutch banking partnerships were securitizing mortgages on plantations in Suriname.
Right.
It's a story of risk, reputation, and even a little bit of fraud.
Yes. It is a fascinating period. We often think about mortgage-backed securities as a modern invention, but our sources reveal a much deeper history.
So how did this all work? Paint us a picture of what it was like back then.
Okay, imagine you are a wealthy merchant in Amsterdam back in the 1760s.
Okay.
You want to invest your money, and you hear about these plantations in Suriname.
Right.
Now these plantations are producing valuable commodities like sugar and coffee, but they need capital. That's where the Dutch merchant banks came in. They'd provide loans to these plantation owners. And then, here's the interesting part, bundle those loans together to create these mortgage-backed securities.
So it's kind of like buying a basket of mortgages instead of just one.
Exactly. It's diversification.
Yeah.
You're not betting on the success of a single plantation, but on a whole portfolio of them.
Right.
But here's where things get tricky.
Okay.
Unlike today, there's no internet, no quick flights to Suriname to check things out.
Right.
Information about the plantations, their value, the planters themselves was scarce and unreliable.
Yeah.
It took 3 months to sail between Amsterdam and Suriname, so it wasn't exactly easy to keep tabs on your investment.
Wow, that's a long time.
Yeah.
So how did investors decide which mortgage-backed securities to buy if it was so hard to get accurate information?
Well, just like you might choose a well-known coffee shop over a random one you've never heard of.
Fair.
Investors relied on a bank's reputation as a signal of quality. Think of it as a brand name, a guarantee of trustworthiness, especially in a time without things like credit ratings or regulatory agencies.
That makes a lot of sense.
Yeah.
So a bank's reputation was really its most valuable asset, especially when dealing with these risky plantation mortgages?
Right.
But how did researchers measure something as intangible as reputation from centuries ago? Did they have like historical Yelp reviews or something?
Not quite Yelp reviews, but they did find a clever way.
Yeah.
The researchers used the value of the bank's office property as a proxy for their reputation.
Oh, interesting.
It's an interesting approach. A bank with a fancy, expensive office in a prime location had a lot more to lose if things went south. Damage to their reputation could mean losing wealthy clients, access to capital, their standing in the community.
I see. So their office was basically a giant physical advertisement for their reputation.
Yes, exactly. And the research found that these higher reputation banks, the ones with the progressive offices,
Right.
they consistently originated higher quality mortgages.
Yep.
They weren't lending out more money than the plantation was worth, which is important for investors because it limited their potential losses if a plantation failed.
So far, so good.
Yeah.
High reputation banks equal safer investments.
Right.
But you mentioned earlier there was a boom and bust cycle.
Yes.
What happened? Was it like the Wild West of finance back then?
Well, towards the end of the 1760s, the Dutch economy was booming.
Okay.
Government bond yields fell, coffee prices rose, and everyone wanted a piece of the action in Suriname.
Right.
So naturally, more and more investors were pouring money into these mortgage-backed securities.
Sounds familiar. More money, more problems, as they say. What happened next?
Well, with any hot market, you get new players trying to get in on the action.
Okay.
Some of these newer banks, particularly those with lower reputations, weren't as careful as their established counterparts.
Okay, so the temptation to cash in on the boom led to some, let's say, creative practices.
Yeah.
What kind of risky things were they doing?
Think of those agents in Suriname, the ones actually evaluating the plantations and issuing the loans. They became less rigorous, handing out mortgages to just about anyone who walked in the door.
Oh, wow.
They were lending to inexperienced planters with limited resources,
Yes.
people who probably wouldn't have gotten a loan in a less frenzied market.
Right.
They even started inflating the value of plantations on paper to justify giving out bigger loans.
Wow, talk about cooking the books. So did anyone see the writing on the wall? Were there any skeptics raising red flags?
There were a few.
Right.
Notary Pool, for example, warned about the inflated appraisal of a plantation called La Félicité. But in a booming market, those warnings often get drowned out by the general optimism and the allure of quick profits.
It's a classic tale of greed and short-sightedness.
Right.
So when did the bubble burst? What was the trigger event?
It all came crashing down in the fall of 1770 when one of these low-reputation banks, overextended and unable to secure the investor funding they had promised, defaulted. It was like a domino effect. Investors panicked, the market tanked, and plantation mortgage-backed securities lost a significant chunk of their value.
Oh, wow.
A lot of plantations were forced to sell, many went bankrupt, and investors were left holding the bag.
Ouch. That's a painful lesson in risk management, 18th century style.
Right.
It sounds like a lot of investors learned the hard way that not all that glitters is gold.
Yeah.
But this raises a question. We know the low reputation banks were playing fast and loose. Did the more established high reputation banks also lower their standards during the boom?
That's a great question, and that's where the research gets particularly interesting. We'll delve into that after a quick break.
Okay.
We'll be right back after this.
All right, sounds good. So before the break, we were talking about how this 18th century Dutch mortgage market went bust.
Right.
I'm curious about those high reputation banks.
Yeah.
Did they get caught up in the frenzy and lower their standards too? Or did they stick to their guns?
That's a really important question because it gets to the heart of what reputation really means.
Right.
And what the researchers found is quite fascinating.
Okay.
They discovered that, by and large, the high-reputation banks maintained their stricter lending practices, even when the market was booming.
Right.
They understood that their reputation was their most valuable asset, and they weren't going to throw it away for a quick profit.
Right.
Now, they didn't entirely escape the downturn.
Sure.
The whole market was affected.
Right.
But their mortgage-backed securities held their value much better than those issued by their less reputable counterparts.
So even in a time of intense speculation and risk-taking, reputation still mattered.
It really did.
It wasn't just about having a fancy office.
Yeah.
It translated into real differences in lending practices and ultimately better outcomes for investors.
Right.
It's interesting how these historical examples can give us such a clear insight into the importance of long-term thinking and responsible behavior.
Absolutely.
Yeah.
And the research goes even deeper.
Examining the role of individual bankers and their personal incentives.
All right, so it's not just about the bank's name on the line, but their own skin in the game as well.
Exactly.
What did they find?
Well, one fascinating detail that emerged from the research is the impact of marriage.
Okay.
Some of these bankers were married into wealthy families, and in many cases, their wives' assets were protected from creditors, usually through prenuptial agreements.
Hold on, marriage. What do wedding bells have to do with risky mortgages?
It's an intriguing connection, isn't it?
Yeah.
But think about it.
Okay.
If a banker's personal wealth was shielded from his business dealings, he had less to lose personally if his bank went bankrupt.
Right.
Essentially, he had a financial safety net.
So those bankers had a cushion to fall back on even if their risky bets went sour.
Exactly.
Did the researchers find any connection between this and their lending decisions? They did. Their analysis showed a weaker link between reputation and mortgage quality when bankers were protected from personal losses through their wives' wealth. They were more willing to take risks, potentially jeopardizing the bank's reputation because they knew they wouldn't face financial ruin personally.
So their personal financial security, in a way, made them bolder, even if it meant the bank might suffer.
Right.
It's like a real-life example of moral hazard.
Exactly.
Yeah.
And it really highlights how personal incentives play such a crucial role,
Right.
even in seemingly rational financial markets. When those incentives are misaligned, even those with strong reputations can be tempted to stray from the path of responsible behavior.
It's fascinating how these seemingly unconnected personal details can have such a significant impact on financial decisions and ultimately on the entire market.
It is.
Were there any other interesting findings about the personal stakes of these bankers?
Yes. The researchers also considered the time horizon of a banker's expected profits. Remember, these merchant banks were often partnerships.
Right.
And sometimes a partner would pass away,
Yeah.
leaving the surviving partner in charge until heirs came of age.
Okay, I see where this is going.
Yeah.
A sudden change in the profit-sharing agreement, right?
Precisely.
Okay.
The surviving partner would get to enjoy all the profits for a while instead of splitting them as before.
Right.
But this also meant that any long-term gains from maintaining a good reputation wouldn't solely benefit them.
Right.
They would eventually have to share those benefits with the heirs once they join the partnership.
So there's a shift in perspective from long-term thinking to a more short-term, make hay while the sun shines mentality.
That's the idea.
Okay.
And the research actually found that when a banker's expected profits were more focused on the short term.
Yeah.
For example, after a partner's death, the positive impact of reputation on mortgage quality decreased.
So in a way, the potential for future rewards incentivized them to act responsibly. But when that future became less certain, their commitment to upholding the bank's reputation weakened.
Exactly. It's almost like a psychological shift, isn't it?
Yeah.
They were less invested in the long-term well-being of the bank because they knew they wouldn't reap all the benefits.
This all really makes you wonder, what are the incentives at play today? Do modern bankers have that same level of personal stake in the reputation of their institutions?
That's a question worth pondering, isn't it? The financial world today is vastly more complex, but the fundamental drivers of human behavior remain the same.
I suppose those who have golden parachutes might not worry as much about a tarnished reputation.
That's a valid point. This deep dive into 18th century Dutch finance brings to light some crucial lessons that are still relevant today, even in our modern, highly regulated world.
Right.
And it underscores the need for transparency and a closer look at the incentives driving financial decisions.
It's a reminder that reputation is a powerful force.
Yes.
But it's not invincible. It needs to be carefully cultivated and safeguarded, both at the institutional and individual level.
Right.
And ultimately, it all comes down to aligning incentives with responsible long-term value creation.
Absolutely.
But what does this all mean for us today? How can these insights from the 18th century help us navigate the complexities of the modern financial world?
Well, that's a question we can explore further.
It's amazing how these stories from the past could be so relevant to our lives today. We've been talking about risk, reputation, and the importance of aligned incentives. But are there any other takeaways from these 18th century Dutch mortgage markets that we should be thinking about?
One thing that really stands out to me is the role of information. Back then, those Amsterdam investors had such limited access to reliable information about those plantations in Suriname. It took months to get updates, and it was incredibly difficult to verify the accuracy of the information they were receiving. That lack of transparency created opportunities for less scrupulous players to exploit the system, and in a way, we face similar challenges today.
You mean with the complexity of modern financial markets?
Exactly. Think about the intricate financial instruments, the algorithms, the high-frequency trading that dominate the markets today. Even with regulations and oversight, it can be really tough for everyday investors to fully grasp the risks involved.
It's like those 100-page contracts with all the fine print. There's important information buried in there, but who has the time or the expertise to decipher it all?
That's a great analogy, and that knowledge gap creates an uneven playing field, giving those with more information, whether it's insiders, analysts, or even sophisticated algorithms, a significant advantage.
So how do we level the playing field? It can't exactly turn back time and simplify the entire financial system.
That's true, but we can become more informed consumers of financial information. We can ask tough questions, seek out diverse perspectives, and demand greater transparency from the institutions we trust with our money. It's about doing our due diligence, not just blindly trusting brand names or relying solely on past performance.
So it's really about taking ownership of our financial decisions, understanding the risks involved, and not being afraid to dig a little deeper.
Absolutely. It's about recognizing that knowledge is power, especially when it comes to our financial well-being. And just like those Dutch investors learned centuries ago, chasing high returns without a clear understanding of the underlying risks can lead to some unpleasant surprises.
Well, this has been a fascinating deep dive into the world of 18th century finance. It's amazing how these historical examples can offer such valuable lessons for us today.
It's been a pleasure exploring these sources with you.
Remember, listener, you don't need a time machine to learn from the past. The more we understand about the forces that have shaped financial systems throughout history, the better equipped we are to navigate the complexities of the markets today. So until next time, keep learning, keep exploring, and keep diving deep.